Close your eyes for a second. Imagine you wake up tomorrow and every number in your bank app is still there. Same balance, same salary, same prices in the shops. But deep down, you suddenly realize something uncomfortable. None of it is real. Not the money, not the value, not even the rules you've been living by. That sounds dramatic, but once you see it, you can't unsee it. Let me show you why money is fake, explained simply, without fairy tales, and why that matters more today than ever before. Let's start with something basic. A 5-year-old question. Why does a piece of paper buy food? Seriously, why does a green note, a printed number, or a digital entry let you trade hours of your life for bread, rent, or medicine? Because we agree it does. That's it. That's the foundation. Money isn't valuable because it's rare. It's not valuable because it's backed by gold. It's valuable because everyone around you believes other people will accept it. Money is a shared story, and stories are fragile. Hundreds of years ago, money was simple. Gold, silver, salt, shells. If you held it, you owned it. If you lost it, it was gone. But carrying gold is heavy, counting it is slow, and kings hate limits. So governments made a deal. They said, "Give us your gold, we'll give you paper that represents it." That paper was a receipt, at first. Then something subtle happened. They realized most people never come back for the gold. So they printed more receipts than gold, just a little. Nobody noticed, and the system worked until it didn't. Fast forward to 1971. This is where the story quietly breaks. The United States officially stopped backing its money with gold. No announcement to everyday people, no dramatic warning, just a decision. From that moment on, money stopped representing something real. It became a promise with no anchor. Every major currency followed. Today, money is not backed by gold, silver, or anything physical. It's backed by confidence. And confidence is emotional, not mathematical. Here's where it gets uncomfortable. Most money doesn't even exist physically. Over 90% of money is just numbers on screens, typed into existence. When you deposit money into a bank, the bank doesn't keep it in a vault. It lends most of it out. Then that loan becomes someone else's deposit, which gets lent again. This is called fractional reserve banking. Simple version, your money gets copied, not cloned perfectly, copied with risk. Banks are legally allowed to create money this way, out of nothing, not counterfeit, not illegal, official. Let's make this painfully simple. You deposit $1,000. The bank keeps maybe $100. It lends $900. That $900 gets deposited elsewhere. Another bank lends most of that. Suddenly, your $1,000 has turned into $9,000 in the system. Did anyone print it? No. Did anyone work for it? No. It exists because the system says it does. Now, here's the twist. Debt comes first. Money comes after. Every dollar created is born as a loan, which means money is not wealth, it's obligation. Interest ensures more money is owed than exists. So where does the extra come from? It doesn't. Someone always loses. This worked when growth was endless. More people, more resources, more productivity. But now, debt is exploding faster than real value. Governments owe amounts so large they can never be paid back, not realistically. So they do the only thing they can. They print. They don't call it printing, they call it stimulus, liquidity, quantitative easing. Different words, same action. When more money chases the same amount of stuff, prices rise. That's inflation. Not because companies are evil, not because people suddenly got greedy, but because the measuring stick is shrinking. You're not earning less, your money is becoming lighter, thinner, hollow. Here's the quiet irony. People blame themselves. I should have saved more, I should have worked harder. But the game is designed so saving loses value over time. Inflation punishes patience. Debt gets rewarded. Assets inflate. Wages lag. This isn't accidental, it's structural. And now, zoom out. Money used to be slow. Paper moved at human speed. Today, money moves at algorithm speed. Trillions shift with a click. Markets react before people can think. Central banks adjust interest rates like temperature dials, hoping not to burn the room down. Sometimes they do anyway. The hype says this system is stable, sophisticated, under control. But stability today depends on belief tomorrow. If confidence cracks, everything rushes for the exit at once. That's why governments fear panic more than inflation. Panic breaks stories. Look at history. Every fiat currency eventually collapses. Roman coins were diluted until silver became dust. Weimar Germany printed until bread cost wheelbarrows. Zimbabwe printed until numbers lost meaning. Each time leaders said, "This time is different," it never is. Now here's the part no one likes to say out loud. Money being fake doesn't mean it's useless. Stories still control behavior, but it means the rules can change overnight. Interest rates, withdrawals, access. What you own may depend on permission. Digital money makes this cleaner, faster, programmable, efficient, and controllable. Numbers can be frozen, expired, redirected. Not tomorrow, but possible. So why does this matter right now? Because trust is thinner than ever. People feel something is off. They can't explain it, but they feel it. Working more, saving less, running faster to stay in place. The math no longer matches the effort. Money didn't break suddenly. It drifted, quietly, comfortably, until now. So here's the unresolved question. If money is just a shared belief, and belief is starting to crack, what happens when enough people stop pretending the story makes sense? Not today, not tomorrow, but eventually. That question has no clean answer, and that's exactly why it's worth sitting with.